Yesterday was the worst performance in the S&P 500 since 2022, and we can see pretty much red right across the board. And when we zoom into purely the semiconductor industry, we see some very large losses. Nvidia notably down just in one day, nearly 7%. Now, when we take a look at this company, its all-time highs we actually saw not too long ago did sit around $141. Right now, in fact, even in the pre-market at $112.76, it is trading 20% lower than its all-time highs. Now, a few reasons that we can discuss for why this may have happened. First one, there was an article from last week talking about how the stock market is effectively rotating out of some of the mega caps, and there is some thought behind the fact that this may not be over yet, and there is still some more blood to see on the streets, not just with Nvidia, but the likes of Google, Amazon, Microsoft, Meta, and some other of those mega caps. Now, another reason that we did in fact see just last week was the increase in the geopolitical tensions. We had a wide sweeping rule to clamp down on companies exporting critical chip making equipment to China coming out of Biden's administration. And we also had something very similar coming from Donald Trump saying how Taiwan should be paying the US for the defense. So we had a lot of catalysts just last week as to why a lot of companies, in particular the semiconductors, were down significantly. Now, we actually had some very good news just over the last few days because two very large semiconductor companies did in fact report their earnings. The first one that we had was ASML, and what they actually talk about is an AI chip demand being boosted by purchases of their products, the semiconductor tools. And on top of that, when we look at ASML's net bookings, it actually rose more than 24% year on year. And the CEO effectively talked about how they see some strong developments in AI, and they talk about how 2025 is going to be an incredibly large growth year for ASML, as well as what they believe to be for the industry. Now, just a very high level, we're not taking a look at this company today, but we can in fact see both on the sales as well as the net profit, they did beat analyst targets by quite a respectable distance. Now, one of the things that we want to point out with ASML, one of the reasons why their company's share price is trading very low over the last few days is effectively 49% of their sales does come from China. So if the risks that have been talked with the geopolitical tensions do take place, they will suffer very, very dramatically. Again, this is all just talk at the minute. The second company that did release their earnings was TSMC, Taiwan Semiconductor Manufacturing, and they also beat. They said that the AI chip boom does continue, and in fact, they're saying the demand for generative AI is surging in the cloud and at the edge. Now, that is very good news for those people that are essentially shareholders in any other semiconductor industry, because it doesn't look like the growth that we have seen just take off over the last few days slowing down anytime soon. And again, we just wanted to point out, very similar to ASML, TSMC did also show a double beat, both on the revenue as well as essentially the bottom line net income. So that is some good news. And one thing to note, Nvidia do have quite some time before they are reporting their earnings. In fact, it is just under 4 weeks today, the 28th of August, and it will be in the post market. Now, how they've performed historically should come as no surprises. Very nice to note, over the last 4 quarters, they have beaten management estimates. And ultimately, this does give us confidence when we are looking at their future projections that they should be able to hit it purely off their very good track record. And one thing to note, from when they do release it next month, they are anticipating triple-digit growth, 136% on a year-on-year basis. And whilst the forward P does currently sit around 41.7, if they do hit that at 3.73, it will dramatically come down to around 30.65. And we are going to take a look at now their historical forward P. And this is just to show you, now typically on this channel, as a little bit of a heads up, we do look at dividend yield theory, but for Nvidia, given the yield is fairly small, we're not going to incorporate that today. What we want to point out, in terms of the forward P ratio, they are trading at just under 40, and this is in fact lower than their 5-year average. Historically, Nvidia over the 5-year period has traded at 42.3. We can see right now it is below 40. So that could be argued as a sense of undervaluation here. But as always, you need to do your own due diligence. And this just makes up one part of our analysis when we do deep dives on companies. Now, we also want to point out in terms of this company, even though it is trading down in the pre-market around $113, it is down again today after just yesterday having the worst performance since 2022 for the overall market. And over the last month, whilst it's down around 7%, this is a company that still, I mean, come on, year to date, they're up triple digits. And over the last 10 years, up 26,500%. So they have a very strong historical performance. In terms of looking at it on a 52-week range, as we mentioned, they are down 20% from the all-time highs, which we have seen not that long ago. And we also note that Wall Street continue to be incredibly bullish. They have that strong buy signal with a double hold from Seeking Alpha and Quant. As we mentioned, very trivial yield, so we don't talk too much about it. And that forward P around 41.7. Remember, if they do hit their earnings projections over the next year, that will come down to the low 30s. We want to point out we have released our latest articles. For those that are paid subscribers, well, they did just get a 55 dividend growth spreadsheet running through all the undervalued companies that we see in our price target. And for other subscribers, we do have tons of other articles that you can read signing up below and get instant access to take a look at now. Now, just running through some of their metrics, again, for those that are maybe new or haven't seen this information, they have some very large growth on the free cash flow per share just over the last few years, something that we will be keeping our eye on to when they do release their quarterly earnings over the next few weeks. The next thing to note is their sales growth has historically been very strong, especially in 2024 where we saw triple digit growth. So our eyes will be on whether or not that growth can be sustained. Can we see Nvidia bring another very strong increase to their top line? In terms of ROIC, as always, we believe this should be one of the most important metrics you look at when analyzing any company. Now, for this industry, 12% or more, we personally say 10% or more just to give us faith management are able to effectively allocate their capital. And what we can see in 2024, 61%, trailing 12 months at 78%. This is a very strong metric and at the right price, incredibly attractive to potential investors. The other few things we want to point out, both on the margin perspective, and this doesn't just relate to Nvidia. We do know that Nvidia has some very nice margins that have increased over the longer term, but it's worth reviewing the companies you're invested in and note two key things. One is the revenue increasing. Second thing are the margins increasing. That is one straightaway sign of a very high quality company if you can see this over the longer term. Also, the free cash flow margin, always great to see companies that do show us that they are a free cash flow machine. Nvidia, again, 45% in 24 does show us that exactly, as well as over the historical period. Finally then, in terms of just metrics, we always want to point out companies that have phenomenal balance sheets. The net debt to EBITDA for Nvidia has been 0 right across the board, as well as over the next 12 months expected. Ultimately showing us their balance sheet very strong. It wouldn't even take them one day to pay off all of their debt net of cash on hand. Definitely something we, again, alongside the ROIC, recommend you taking a look at for your company. The stronger the balance sheet, always the better investment in our opinion. Now, before we get to our valuation and run it through the valuation model, the few things to note at why this company does trade at a very expensive rate in comparison to the sector. Just look at their year-on-year growth. As we said, triple digit, 208. The sector as a whole, low single digit. Moving forwards, they are still anticipating very rapid rate, whereas the sector median, even though it has increased from the year-on-year perspective to forward-looking, still mid-single digit is absolutely minuscule in comparison. And the earnings per share generated, anticipated though, over the next 3 to 5 years, 33%, with the sector around 14. So you can already start to understand, and again on any other growth metric as well, they do get a very solid A or A+, why this company does justify a very large premium. Again, we can show you the same on the profitability, and these are some of the best profitability metrics you will see in a company. 75% gross profit margin versus the sector of 49, and on a bottom line perspective as well, 53 versus a low 3 for the sector as a whole. So you can see how strong this company is, and in terms of cash from operations, 41 billion is absolutely insane, especially when you consider the sector median is around 96 million. So they have a lot of cash that they have generated. We believe they will continue to generate, and what we envision they will do with this cash over the longer term is return that to shareholders, whether that is through share buybacks, whether that's through another triple-digit increase to the dividend, or other ways where they reinvest it into the business with a very high ROIC that they do hold currently as well as historically. Now we want to just explain our intrinsic value, and as always, if you do enjoy the content, value has been provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. We just want to say our valuation has not changed at $140. We also know Wall Street pretty much see the same price, and they believe upside of 25%. Now, how we got to our intrinsic value? Well, we put it through our DCF model. We have the free cash flow year on year. The average growth rate of this is 94%, and we have gone from 3 different rates, a low, medium, and high. Now, we've used a medium rate today of 30%. With that discount rate, we get the present value of future free cash flows and terminal value, which we add together with the cash, subtract total debt, get to the equity value, and ultimately divide by the shares outstanding. Now, this implies upside of 24%, but we can also see that people would argue that is way too optimistic. At the 25%, again, just for transparency, when we put it into the model, it gets an intrinsic value of $101, indicating actually downside around 11% on top of the drop we have seen just yesterday. Now, conversely, there will be people that say that is way too conservative and they want to go more towards the higher rate of 35%, and that would ultimately give an upside of around 70%, price target $192. Now, these numbers are subjective. You can grab a copy by clicking on the pinned comment below, running through your own numbers, but as we said, we do believe that around 30% is the rate we will take through, ultimately lower than the average growth rate over the last 10 years and lower than the astronomical increase we just saw in 2024. Now, when we pull that through to the intrinsic value, we always like to use a margin of safety on the episode, and we start off with 10%, and we ultimately execute on that 10% if we believe it meets the 3 criteria: a wide moat, strong financial metrics, and good forward-looking data. Now, you could argue that it meets all of these criteria in today's episode, but we keep going anyway till it's near the current trading price, and what we ultimately see, it isn't too far off, around $1 difference from a 20% MOS, based on those estimates and judgments we just ran through. Remember, around a 30% growth rate moving forwards. So with a 20% MOS and 25% upside, as we said, Wall Street do consider this a strong buy. But as always, do let us know your thoughts in the comments below. And for those that actually prefer to have the security of an ETF rather than be invested in companies that can be very volatile and see very large increases and decreases, there is the alternative of a semiconductor ETF, which does have exposure to Nvidia. For example, the SMH VanEck Semiconductor ETF, which we do know Quant does give it a strong buy. Over the last month, following the trend of semiconductors, it is down around 8%, but we know year to date it is up around 38%, and over the last 10 years is up 962%. Now, it does have a yield on a trailing 12-month basis at 0.43%, and we do know the expense ratio does sit around 0.35. Now, for those that want to understand what is included within this ETF, well, the top 10 holdings, as we can see, Nvidia does make the top place, 20.2%. So you are still getting that exposure to Nvidia, but if you have very large decreases or increases, at least that is spread across many others in the industry. We also have TSM and Broadcom in second and third place. And for those that maybe don't find SMH as their preference, one thing we would want to point out, yes, you could look at others in the industry. We have XSD, we have some very popular stocks as well as SOCQ, that they do have different expense ratios. In fact, SOCQ does have around 0.19%, which is lower. Ultimately, what we found quite interesting when we looked at it on a total return perspective, over the last year, SMH has outperformed every single one. This includes reinvesting that marginal dividend. Over the last 5 years, again, the same is still to be said. 315% completely outperformed the others. And when we look at it over the last 10 years, again, 1,013% reinvesting that dividend. So ultimately, yes, it does have different expense ratios depending on which ETF you want to consider, but it could be a good alternative to investing in individual semiconductors if you prefer a little bit more safety and security, as well as potentially avoiding overexposure. As always though, do let us know your thoughts about today's episode. If you enjoyed it, smash that like button, hit that subscribe and bell button, let us know your thoughts below. And if you do want to see some other undervalued stocks that we do believe deserve your attention, do go and check out that free weekly newsletter. As always, take care and we'll see you all on the next one.